Major funding for these broadcasts has been provided by grants from New York Community Bank, AmTrust Title Insurance Company, Perfect Building Maintenance, M&T Bank, Customers Bank, Marks Paneth LLP, Capital One Bank, Collins Building Services, Meridian Capital Group. Additional support has been provided by grants from AKA Hotel Residences Corman Communities, Ariel Property Advisors, Amerant Bank, Bank of America Merrill Lynch, Briarwood Organization, Chase Commercial Mortgage Lending, Chase Commercial Term Lending, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC, Handler Real Estate Organization, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Casamatides Red Apple Group, Keysight Capital Partners, Matone Group, New Banks, Newmark Knight Frank, Ocean First Bank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Services, Stonehenge NYC, SVN CPEX Real Estate Services, Tierra CRG, the Meringer Family Foundation, and these friends. Hard to believe that it's 9 months during the pandemic. What's happening for real estate financing? Banks are deferring loans. People have no idea what they should be doing with regard to buying, selling, financing. So today, with the help of my friend, Mr. Ronald Levine, I've assembled a group of individuals to provide their thoughts on alternative lending for financing for real estate during a pandemic. My guests include Martin Nussbaum, co-founder and principal of Slate Property Group and also co-founder and principal of Scale Lending. David Schwartz, partner at the Sugar Hill Capital Partners, Fort Amsterdam Capital. Jason Bordenek, managing director and co-portfolio manager at Maxim Capital Group. And last but not least, my executive producer, wearing his nice blue suit today, Ronnie Levine, senior managing director at Meridian Capital Group. So Ronnie, since you've assembled this group of distinguished individuals over there, what's happening with money? Is it available? Because some of the banks that I talk to say, I don't want to put out any money. I have no idea what's going to happen with the pandemic. I don't care if there's a vaccine. Condominiums are in trouble. Rental apartments are in trouble. The world is coming to an end. What's really happening, Ronnie?
I think that that's part of the story, and there's a lot of accuracy to that. The banks are definitely very conservative in this market. We've seen significant pullback in the A-note market. But there's been, I think, a lot of liquidity provided by the alternative lender universe, with certainly from the groups on this panel and others. We've seen them kind of step in and fill a need in the market for capital. But also, the conversation needs to be a little bit more nuanced in terms of geography, asset class, business plan. Look, Fannie, Freddie, HUD, there's plenty of capital for multifamily cash flowing deals. There's capital for multifamily bridge loan deals. Office deals in certain markets get attention and others don't. Ironically, in New York City, working on some office deals, it's extremely challenging to get deals done in Manhattan on office. But then I've got an office deal in Texas that I'm getting traction on. So, it really is an unpredictable market. And I think, fortunately, there's capital sources out there that will listen and, try to dig into specific business plans to fill the kind of void that's been left by some of the banks that are sitting on the sidelines.
It's interesting that we have David and Martin, who are basically also in the operations of buying property. They manage property, they own their property. How are you seeing as a borrower, and then I'll ask you as a lender, how do you see the world today handling your category of multifamily transitionary properties, not the Fannie and Freddie properties? How are the banks treating you when you're looking for financing? David?
Fortunately, we have an amazing broker, which is Meridian Capital. And they've actually done a really good job. We were very lucky in the very beginning of the COVID crisis. We were able to get some a refinancing of several of our properties. The banks have grown more conservative since then, and it's been more difficult. Their criteria have changed quite a bit. I guess the area where there's most concern is just, what's happening to vacancy rates. Rents are coming down, vacancy rates are going up as a lot of people moved out of New York. We're starting to see that shift a little bit. People are starting to come back. Fortunately, our collections have been very, very high, and that's actually helped and encouraged the bank. So we're in discussions on several transactions, mostly refinancings. We're not doing a lot of new transactions in New York, although we are actively looking in and outside of New York.
So now let's put your other hat on as the lender. What are you doing, and what type of deals are you interested in doing in this market?
The bigger challenge to New York in the residential side is really what happened in 2019 with the changes in the New York laws. Those were a gut punch, and I would argue it was a warm-up to some extent for what's happened with COVID. I think most people expect we're going to get through COVID. We've had some reasonable news in the last few days, offset by some bad news about the increasing numbers. But I think most people expect that by the end of next year, we're going to see some, light at the end of the tunnel. So we are actively looking at transactions. And we know that the banks have been giving some pretty generous forbearance agreements to some of our borrowers. That will end. When it ends, it'll be interesting to see the dynamics between what the borrowers are expecting and able to get done, and what is a reality in terms of the value of these properties. We probably will observe a higher vacancy rate for quite a while, and concessions being made by landlords in order to get their apartments rented. But we're reasonably optimistic. And having said that, we're not overly busy right now. We're working on several transactions, but matching the reality of what's expected by our borrower with what we think is the true value is still a fairly wide gap.
Martin, as I said to David, you're in both sides of the transaction. How do you see the financing for the Slate Group, and how do you see the lending for the Scale Group?
I echo a lot of what David said. I think that so far the loans that we have outstanding have been worked out with the lenders. We've supported the deals. I think fortunately our portfolio is generally sort of lower leveraged than what I think would be very dangerous in this market. So typically we're 60 to 65% levered type of borrowers. So and I think it's one of the first times in my career that I've really appreciated having really strong relationship with certain banks and certain debt funds, and how that has resonated. So I think it's a lesson learned for all of us is, relationships do really matter in difficult times. And it couldn't be more clear to me on the equity side of the business that that's true. On the Scale side, I would say that we're about as busy as I've been in the last 2 years in terms of deal flow, not necessarily executing on it, but the amount of deal flow that we're seeing is probably 3-4 times what it was 12 months ago, with frankly a lot less competition. We are closing a loan today, actually, and we probably have 5 or 6 loans signed up and looking to close in the next 2 to 3 months. To your main question is, what is the benefit of having the equity knowledge on the debt side, is that we have real-time data. And unlike a lot of other lenders who are running reports and appraisals that frankly, by the time they get it, it's so dated because information is changing weekly at this point, not monthly, not quarterly. The day-to-day information that we get from our portfolio allows us to really see where the market is and underwrite to what it really is happening today. I agree with David that the market will correct itself over the course of the next 12 to 18 months. And we're looking at our loans in that way, which is I have no intention of being taken out of anything I finance today in the next 12 months. It's more of a 18 to 36 month horizon. And I think that there is a lot of liquidity to what Ronnie said. When you do have a stabilized asset, there's a lot of very interested, inexpensive money available for the takeout of the financings that we're doing, that I think is going to ultimately lead to a pretty successful outcome on the lending side.
You know, you just mentioned that you're closing the transaction today. Could you tell us about the transaction?
We're actually closing a condo inventory loan on the Upper West Side, on a building that is about 50% sold out. We have been working on the deal since April, just to give you some timeline of how long it's taken for us to get to where we are actually closing on it. But we've stuck with it throughout it. And at the end of the day, the economics are in the range of sort of a 600 to 700 over, a LIBOR floor of 1, on a 24-month horizon. And it's not a lot of units. It's only about 20 units left to sell. The basis at which we're at, we're extremely comfortable with. Frankly, during our closing period, they've sold 3-4 units over that period of time. So there is a market for condo exit at appropriate pricing.
What's your basis per square foot for the condo?
It's a complicated deal because there's a land lease in it, so it's not a straightforward sort of condo deal. First 50% of the units sold out at approximately $19,000 to $2,000 a foot. The units that have sold over the last 3-4 months are closer to $1,600 to $1,700 a foot, to give you a metrics when you sort of value in the lease payments and the land value and something like that. So I would say that, and there's a real market there. So if the sponsor wanted to sell out the building, they could easily do so at the basis that we're talking about, but they feel that they're going to move the certain units they want to move at a certain price number, price per foot that makes sense for them. And they're going to wait it out until the market gets a little bit better to move the rest of the units.
Jason, you've been involved with financing in the alternative market most of your career at a number of places. How do you look at the market today, and what are you doing at Maxim?
I think the market is one of the most interesting times to be a lender since post global financial crisis. We're seeing a ton of more interesting opportunities during the pandemic. Maxim is a direct commercial real estate bridge lender. That's our sole business. We don't have an equity business. We've originated over $2.5 billion over the past 10.5 years. And of that, 60% has gone to repeat sponsors. So, we're using this opportunity to continue to build our franchise, continue to do right by our existing client base, and frankly, to pick up some new relationships with those that, haven't transacted with Maxim in the past. We directly originate, service, and asset manage our entire portfolio, which I think has given us, a leg up against some of our competitors in the current landscape. Early on in the pandemic, because of our direct servicing and asset management, we could see into which loans would potentially have problems, and we proactively managed through our entire portfolio. We have a great track record on our existing portfolio, and we've been able to lend throughout the pandemic. We've lent north of $200 million in the last 8 months. We have another $100 million that's closing over the next 4 to 6 weeks. We've been very active, and look, we've been in this business for a long time. We provide event-driven financing, so there has to be some story to it. Either someone putting in dollars that are accretive to the project. It's very important for us to underwrite the sponsor and to know who we're doing business with. But this is the time that we can stand up, and we know the risks that we're taking. Wherever our floor of rates are right now, we're using this time to upgrade our portfolio, and instead of reaching for extra hundreds of basis points in yield to do the same types of deals, we can now stretch down and do some deals that are less transitional, more institutional quality sponsorship, and still get a premium for those deals.
Ronnie, since the beginning of the pandemic in March, have you seen more new people come into the market as lenders?
No, I mean, there's been a few, but I think honestly, the opposite. We've seen a lot of lenders that went to the sidelines. Good amount of them are still there. They're spending a lot of time asset managing deals, dealing with portfolio issues, dealing with funding issues in terms of shoring up their lines of credit or understanding their repo position. So, we're seeing people slowly dip their toe back into the lending market. Some people that were on the sidelines are starting to look at new originations, but I don't think you've seen a ton of new entrants. Where you're seeing new capital flood to the market is really in people looking to buy distressed debt. So to me, that's different than originating new loans. You've seen a lot of the hedge funds or private equity vehicles gearing up to buy loans and to take advantage of what they see as a significant amount of distress on the horizons. So that's different than direct originations, but that is obviously a trend that I think will accelerate over time.
One of the things that I think Ronnie said is accurate. Like the competitors that we were used to seeing in the marketplace over the last, pre-COVID, we're just not seeing a lot of that competition when we are bidding on deals right now. So I think to Ronnie's point there, a lot of the lenders who were in the space, the cheap side, the 3% money versus the 5, 6, 7% money, I think right now are really working out what they have to work out in their portfolios and managing through it and making sure that the loans themselves are performing, not dissimilar to like how we are doing the same on the equity side of our business. We are making sure that we are shoring up our balance sheets in the right place with our lenders, asset managing them to death until they're at a place where they're operating at a level that we're comfortable. But on the debt side of our business, where we are relatively young, the majority of the loans that we've done historically have been ground up construction type deals. So the 80% of those loans are in construction, they're capitalized appropriately, they're moving ahead forward. We don't have any issues, which allows us to be very open to new business, and there's a lot less competition. And the typical players who are in the space are just not in it right now, which is a benefit to everyone on this call.
Since most of you deal with a note-on-note financing from banks, have you seen any banks, any new banks come into the business, or have we seen certain of the lenders who were in your framework leaving the market?
Maybe I could step up and take this one, because Maxim is a provider of note-on-note financing. Have talked to David in the past about potentially partnering on some things. We've been in the space, prior to the pandemic. Unfortunately, there wasn't a ton of opportunities for us to take collateral assignment and provide note-on-note. We're seeing many more opportunities. We've closed a few during the pandemic and have been able to be a trusted resource in that space. And a lot of times right now when people are buying debt, the debt doesn't actually trade, or there winds up being some sort of friction at the end where the sponsor can pay down the debt, the underlying sponsor, or something, a default is cured, whatever that may be. I think that in theory, a lot of people have raised capital and are waiting for this significant wave of distress. I think outside of hospitality and retail, you haven't seen a ton of that actually happening. So I think a lot more of the note-on-note and non-performing note purchases that people are talking about haven't actually come in and transacted.
I mean, what we saw a few months ago, a lot of the large bridge players who use CLOs and other forms of securitizations and warehouse facilities to finance their loan positions got into, some hot water because of the mark-to-market on those portfolios when the world, sort of had the dramatic changes earlier this year responding to COVID, that a lot of those big players have really gone to the sideline. Our business doesn't really compete with them. They're the much bigger players, but it's actually opened up opportunities. And to take Jason's point, there are new players who may have been available to provide note-on-note financing before, but they've really stepped up their business in response to the fact that some of these larger players have been hamstrung by the changes in the securitization market. So we, for example, are both a provider of senior risk to some of our loan-on-loan type products, but also we're a user for some of our own loans. So we've seen a fairly large change and shift in that market, which for us has actually been positive. And I include Jason's business in that because they're fairly competitive.
So here's a question with regard to what happens when somebody calls you up and says to you, I want to finance a hotel or a retail shopping center, or even a mixed-use apartment house in the 5 boroughs that has, 30% retail tenants. Do you say, do not pass go, do not collect $200, and thank you for the call, but don't talk to me right now?
Look, the reality is it depends if it's an acquisition or if it's a refinance. Every deal from our perspective is financeable at a certain level and at a certain price. You may not like the terms as the borrower, but you can get a hotel deal financed it will be abusively expensive and ridiculously low leverage, but it can be financed. So the challenge is people that need refinances. First of all, you likely couldn't get it. And if you could, the amount of equity that would be needed to right size the deal, it would be impossible. So I think that's where what you're seeing is a kind of a differentiation between the refinance market and kind of an acquisition financing. And I'm not saying acquisition financing for hotels or retail is easy, because it's not, but at least you've got a story of fresh capital coming in, somebody with a vision, you can sell a basis play. And I think everyone on this panel would look at some of these business plans if the basis was right and they felt comfortable about the sponsorship and the amount of equity going in, and you could really do a pretty conservative underwriting on the business plan and feel good about your exit. So I don't think anyone believes hotels are going away. The real question is how quickly do they come back and where do occupancy rates and ADRs settle out. But so it's not pretty, but there's still financing out there for those asset classes.
Years ago, many of you were lending on repositioning of assets. Following in the same vein of repositioning, people are talking about taking hotels and converting them into offices, one, taking hotels and converting them into residential. If someone came to you with those types of ideas, what's your interest in doing something like that? Jason, Martin, and David?
To Ronnie's point, it really depends on what the actual business plan and why the person is doing it, the layout of the property, how easy it would be to convert the sponsor's expertise and track record and actually doing something similar. Sometimes it's a lot more complicated when you start ripping down walls of an existing building versus building ground up. Once you start to see what's really behind the walls, but I think we can do a deal like that. We would be selective in the sponsor that we're choosing, the amount of equity that they're putting into the deal, the location, et cetera, just like we do on every single deal. Each deal that we look at comes in and we evaluate that on its own merit. We don't redline, a certain specific asset class or type of deal for any reason, globally.
David?
Yeah, we do see a lot of those opportunities. We like those opportunities. The problem is that when we drill into them and look at the numbers, we find that the borrower's objectives and assumptions are a little far away from where we are. We, for good news or bad, we have a lot of experience looking at, buildings where you're repositioning the whole building as opposed to doing a ground up. And, Jason pointed to this fact that it's probably harder to take an existing building and restructure the whole thing with moving walls and elevator banks and windows than it is to actually do a ground up. So the numbers are too optimistic. So we've worked on many of these transactions, and, I'd love to hear Martin's view on this because I know they're very active. We just don't see the numbers working. And we have a couple that we're working on right now, but it's there's a lot more out there than what we're able to get comfortable with.
Martin, since, David asked the question, answer the question if you can.
Yeah, we are looking at it. The reality is it hasn't really happened yet for all the reasons that David just mentioned, because the metrics just aren't making sense quite yet, but it will happen. And I think the way that we're looking at it is, frankly, we have a lot of experience doing what a borrower is going to come to us and ask to do, which is taking an existing building, essentially stripping it down, and building whatever they need to do with inside of it. And I think the expertise there that we have is going to allow us to either get comfortable or not comfortable with the underwriting that someone's going to provide to us. With time, there's going to be some transactional activity that we will definitely get involved in. There's a few of them now that I think are interesting, but I just don't think right now the sellers and buyers are at the same page, as to where transactions are going to happen, which is why you're seeing the volume of actual acquisitions being next to zero in this space for hotels at this particular moment. I think it could change in a month or two. I really do think that the market moves so quickly right now. I've never seen it happen before in my career, where week over week, there's realizations that people accept or don't accept, and then you move on to the next one. And I think that quarter of next year, specifically in the retail and hotel market, there's going to be a lot of realizations that are going to lead to some transactional activity for everyone.
With the discussion that everybody's talking about working from home, how do you look at somebody who came to you and said, I'd like you to refinance my office property?
it's very challenging. Sitting here in Manhattan, where depending upon whose statistics you look at, I think occupancy right now is hovering around 15%. Some buildings 20, some buildings as low as 10. And there's a lot of sublease space in the market. The co-working spaces are the co-working tenants are giving back space. And so it's challenging. And lenders right now don't have any conviction around where, it's clear, one thing's clear, rents are probably going to need to adjust downward. And I think as a lender, it's challenging when you don't really know exactly where that's going to reset. If you look at what's happening in the financing market, it's definitely, it's cliche, but it's a tale of two cities. You've got the Class A trophy office buildings with long-term leases and good weighted average lease terms to quality tenants. Those are financing very well, and there's a lot of activity in those market. For those loans, the CMBS market loves them. The life insurance companies love them. But if you've got a mid-block office building with a lot of near-term rollover and a co-working tenant in it, it's a very challenging market to navigate right now.
Hopefully 2021 with a vaccine and other situations will make everything great, or better, not great. I'd like to thank David, Jason, Martin, and as I said, Ronnie, and I'll see you next week.
Thank you.
Thanks very much.
Thank you for having us.
Mike.